Well, I think what's going on right now is that investors are happy that we have strong employment data, but they also notice that the wage component was not getting out of hand. And typically, wages are the biggest component of inflation since 70% of our economy is consumer related. Also, with the Biden spending plan that is working its way through Congress and likely to be uh, finally approved by the House, again, it's more money that is coming into the system, but it is transitory in nature. It is short term in nature and probably not likely to be boosting inflation, but it is likely to be boosting the stock market because with interest rates as low as they are from a savings or a checking account, investors have nowhere else to put it except into their investments. So I think that we are likely to see a new high in the Dow, the S&P fairly soon, and then we decide where we go from there. I think tech is a very important sector, but the problem is it got well ahead of itself. If you look at the growth component of the stock market, so there's growth, there's blend, there's value. Growth is dominated by consumer discretionary, technology, and communication services. In August of last year, we hit an all-time high going back to the mid 1970s of how well growth did versus value, even much better than what we saw in the late 1990s. So unfortunately, technology got well ahead of itself, and I think we are going through a much needed digestion process. We have a market weight representation on technology. We downgraded technology several months ago because of this excess, but we don't think that they're worth underweighting at this point. We believe that tech will revive itself later on, but it just has to go through this digestive process now. Well, technology does certainly have long-term growth opportunities. But the thought is that investors now are focused more on the cyclical sectors. They're focused on the sectors that have been underperformers over the last couple of years. In particular, the materials stocks, which are proxies for commodities, industrials, which are likely to be the beneficiaries of infrastructure spending plans, et cetera, as well as energy and financials. So energy should do well as the economies reopen around the globe, and financials should do well with a steepening yield curve because the Federal Reserve is digging its heels in to say, no, we're going to keep the short end of the yield curve very, very low. But since the bond market moves the long end, that's why we're seeing it creep higher and steepen the yield curve, which tends to benefit the financials. So I think right now investors are saying, yes, tech has a good long-term growth potential, but in the near term, let's go for those groups that had been beaten up. Green energy certainly has a good future because it's starting from almost nothing and has an unlimited growth potential over the many decades. However, today, in terms of homes, automobiles, factories, et cetera, that's what, still 70 to 80% plus fueled by fossil fuels. So we can't just assume that fossil fuels are going to go away tomorrow. Yes, I think a lot of the incentives will be for green energy. But in the meantime, we're going to continue to need energy. And should there be any kind of disruption in energy, that would cause a major problem around the globe. Well, certainly healthcare, the sector itself, we recently downgraded to market weight from overweight, mainly because we already have the third vaccine introduced to the marketplace and more are being introduced around the globe. Investors like to get in early on any kind of a new move, but healthcare is sort of late at this point. Healthcare will be important going forward, most certainly. So larger pharmaceutical firms with good R&D departments that also pay a nice dividend yield, I think will be very attractive opportunities for income-oriented investors for some time to come. Well, the problem with gold is that when interest rates rise, then gold has a lot of competition for a couple of reasons. First off, gold does not pay a dividend. And so investors who are income oriented are looking to higher yielding stocks as well as bonds, which are becoming more and more attractive because of the rising yields. Also, while gold does well because of the worry about inflation, if interest rates are then expected to rise to cut off inflation, that too ends up being a problem because it costs money to store the gold. And usually the cost of storing gold goes up as interest rates rise. So, in general, the feeling is that gold you want to own when you are very uncertain about things and are very nervous. But if the economic prospects are brightening, if earnings are increasing, if share prices for equities are rising, then there typically are better opportunities elsewhere.